So the first one is harnessing the power of compounding interest. Now, there was a multitude of years until I was actually in my mid 30s where I really understood compounding interest, even looking at the stock market, CDs, things of that nature, where you can actually turn your money, your savings, your investment into a machine that literally can compound and double every 7 years, which is roughly the estimation that they use. When you start thinking of retirement planning, when you start looking at a child's education, even thinking of you, the most powerful thing that we do have in our toolkit is time. When you think about the unsurmountable edge, really the ability to compound that money, when you think of Warren Buffett, when you think of the great investors that we see of our time, it is about investing on a consistent basis and allowing that money to grow over an extended amount of time. Now, of course, the younger you are, the earlier that you start. If you're 18, if you're 20, if you start putting money into IRA accounts, Roth IRA accounts, if you start putting it into your 401k, leveraging compounding interest can make monster goals when it comes to retirement very, very realistic, very doable, and honestly, a lot less intimidating when you look at a full figure where, hey, fully funded retirement, people are saying 1.2, 1.4 million. If you start breaking that down over 40 or 50 years with regular contributions and that compounding interest over time, it can make it very achievable. Now, of course, the compounding effect isn't linear, it is exponentially on the amount of money you have. So you can start growing. And honestly, when you start looking at someone like Warren Buffett with his large portfolio, when he hit the age of 65, the compounding just goes off the scale. When you look from 65 to 70, from 65 to 75, even 65 to 85, it is incredible how fast and how much it can compound. When you start even thinking of high yield savings accounts, bonds, mutual funds, investments, it is starting early, staying consistent, which if I knew this 10 years earlier than I did starting really at 35 to put a lot of money into my 401k, I would have much higher balances than I do today.